We're analyzing Alphabet stock to see if its market price is a fair value. Alphabet or Google trades under two tickers, GOOG and GOOGL. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Alphabet. Then we're giving a final rating to the business as we analyze it for your portfolio. Before we get into these valuable metrics, let's understand Alphabet's stock performance. Alphabet currently trades for $104.72 per share. In the last year, their stock price is down 27%. They've declined faster than the S&P 500 has during this time. Over the last 5 years, Alphabet is compounding their stock price at 15% annually. Over the last 10 years, Alphabet stock is compounding at 17% annually. Going back prior to the global financial crisis, over the last 18 years, Alphabet is compounding their stock at 18.5% annually. They're massively outpacing the market over this time. Alphabet trades about $20 above their 52-week low. The company is still down $40 from their 52-week high. Alphabet is one of the largest businesses in the world. They have a $1.3 trillion market cap. That's $1,339 billion. To learn more about the business, Alphabet is a holding company. Internet media giant Google is a wholly owned subsidiary. Google generates 99% of Alphabet's revenue, of which more than 85% is from online ads. Google's other revenue is from the sale of apps and content on Google Play and YouTube, as well as cloud service fees and other licensing revenue. Sales of hardware such as Chromebooks, the Pixel smartphone, and smart home products, which include Nest and Google Home, also contribute to other revenue. Alphabet's moonshot investments are in its other bets segment, where it bets on technology to enhance health, such as Verily, faster internet access to homes through Google Fiber, self-driving cars through Waymo, and more. Alphabet's operating margin has been 25 to 30%, with Google at 30% and other bets operating at a loss. The company was founded in 1998 and is headquartered in Mountain View, California. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. There are two key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. These business returns are captured here by return on capital. The second is the average publicly listed business earns about a 7% return on capital. By asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Google has earned above average returns in all 5 of these years. Their returns on capital really kicked into high gear after 2020, and in their most recent fiscal year, the company earned 26% returns on capital. Averaged out over the last 5 years, Google earns about 21% returns on capital in a given year. This is 1.5 times better than that benchmark we were looking for, and 3 times better than that of a typical business. So this is a strong check starting off on metric number 1 for Alphabet. Metric number 2, we're looking at high-level growth for Alphabet. We want to see growth in their revenues, net incomes, and free cash flows over their past 5 years. This metric is all or nothing. All 3 of these have to be up for this to be a check, or if even one of them is down, this entire metric will be an X. Alphabet has doubled their revenues, they've almost doubled their net incomes, and they've almost tripled their free cash flows in the last 5 years. This is very strong growth across the board here, and this is a massive check on metric number 2. Great to see that their free cash flows led the way for this growth, because free cash flow is the lifeblood of any business, and ultimately a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business will be worth. We'll be using that exact method to come to an estimate of Alphabet's intrinsic value later on in the video, so stay tuned for that. A company can use its free cash flows in a handful of ways. They can buy back shares, pay down debt, pay dividends, make acquisitions, or reinvest back into the business. We're flawless through our first 2 metrics. Metric number 3, we're taking the perspective of an individual shareholder in Alphabet by looking for earnings per share growth over the last 5 years. We just learned that their net incomes, otherwise known as their earnings, have just about doubled over the past 5 years, and at the same time, Alphabet has bought back about 6% of their shares outstanding. This is likely a good sign for long-term shareholders in the business, because when you purchase a share of stock, what you're really doing is buying a fractional ownership percentage in that underlying business. So when a company buys back shares by decreasing the number that they have outstanding, they're increasing your ownership percentage in the business, which will ultimately increase the percentage of the business's profits that you're entitled to without you having to spend a dime. It's almost as if the company is making a partial acquisition of itself. Just like with any other acquisition, we want the business to be getting more value than the price that they're paying. There are a number of factors that will determine this. With their strong earnings growth and their share buybacks, this is another check on metric number 3 for Alphabet. Metric number 4, we're looking for free cash flow per share growth over the past 5 years for Alphabet. Similar to their earnings, Alphabet has strongly grown their free cash flows, and with these slight share buybacks, this is strong cash flow per share growth. This is another check on metric number 4, and through our first 4 metrics, we are perfect for Alphabet. There's still one vital piece of our analysis missing. You might think that nailing high returns on capital and having strong growth is the key, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. In metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over the last 5 years. We don't want to be investing in overly levered businesses. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. Alphabet has had negative net debt in all 5 of these years, meaning that they've had cash left over after paying off all of their debt, and they have a massive cash cushion. Right now, Alphabet has an $84 billion cash cushion on their balance sheet. This is huge, and in absolute terms, it's one of the largest of any business in the world. At the same time, Alphabet has produced $224 billion of free cash flow in the last 5 years. That's absolutely massive. Again, there are only a handful of companies in the world that can even rival this. This is a massive check here on metric number 5, as both relatively and in absolute terms, Alphabet is strongly cash flow generative, and they have a very strong balance sheet. Through 5 metrics, we're perfect on Alphabet. Let's see if Alphabet has what it takes to be a perfect select 6 stock. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will provide a slight risk premium to the yield of the 10-year treasury, and it may offer a potential starting point for a reasonable valuation of Alphabet. Alphabet has a $1.25 trillion total enterprise value, which we're using because it takes into account both their market cap and their net debt position. It gives a perspective of Alphabet that's more similar to as if the company were a private business. We learned that Alphabet produced $224 billion in free cash flow over their last 5 years, meaning that in an average year, the company produces about $45 billion in free cash flow. So when we divide their $45 billion of their average free cash flow by their $1.25 trillion total enterprise value, that gives us about a 3.6% average free cash flow to enterprise value yield for Alphabet. In their most recent fiscal year, the company produced $60 billion in free cash flow. When we divide their $60 billion of their most recent fiscal year's worth of free cash flow by their $1.25 trillion total enterprise value, that gives us about a 4.8% current free cash flow to enterprise value yield for Alphabet. Both of those are around the yield of the 10-year treasury. However, they're slightly below that 5% risk premium we'd be seeking. On an average and a current basis here, this is an X on metric number 6 for Alphabet. Please don't throw this business out in its entirety. This is not a buy or sell recommendation of any security. It's not financial advice. You'll want to stick around as we perform a discounted cash flow analysis to come to a more concrete estimate for an intrinsic value of Alphabet, and stay tuned for our final rating of the business. As promised, everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Alphabet, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Alphabet. A discounted cash flow model is based off the predictability of a company's free cash flows, which Alphabet has had a very predictable business in its past. That potentially better informs this analysis. A discounted cash flow model is just like any other model in any other discipline. Its outputs will be sensitive to its inputs. Here we're starting with Alphabet's current free cash flows per share, and we're using historical growth assumptions to project these into the future. If we assume that they grow their free cash flows at a rate of 12% annually for the next 10 years, then that growth rate is cut in half for the 10 years out after that, and they grow at a rate of 6% annually. If we add in the company's tangible book value, which gives us an estimate of their tangible net worth, and we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for from his investments, in addition to his margin of safety requirements, it looks like at today's valuations of Alphabet that a potential fair value for the business is around $80 per share. While that is $24 below their current stock price, that's just a little bit less than what their 52-week low was. While it doesn't look like there's a margin of safety at today's prices, this is pretty in line with where Alphabet has been at over the past year. There are some key points to keep in mind here. Alphabet has had a high degree of business predictability in its past. That's not necessarily a guarantee for the future. Also, please be mindful that this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, please consult with your financial advisor. In just a minute, we'll talk about our final rating for Alphabet, but we have to address something first. What are the qualitative aspects of this business? Starting with the qualitative aspects supporting a long thesis for Alphabet. Number 1, the significant cash generated from the Google search business allows Alphabet to remain focused on innovation and the long-term growth opportunities that new areas present. Number 2, Android's dominant global market share of smartphones leaves Google well positioned to continue generating top-line growth as search traffic shifts from desktop to mobile. Number 3, as the number of online users and usage increases, so will digital ad spending, of which Google will remain one of the main beneficiaries. subsidiaries. Then for the key qualitative points around a potential short thesis for Alphabet, Google's dominant position in online search may not be maintainable as more companies and regulatory agencies are contesting the methods through which the company has been extending its leadership. Number 2, Alphabet is allocating a lot of capital toward high-risk bets, which face a very low probability of generating returns. And number 3, there is little revenue diversification within Alphabet as it remains heavily dependent on Google and the state of the search ad space. Keep in mind that applies to Alphabet, the holding company as a whole, not necessarily within Google itself. There you have it for some of the key qualitative aspects of this business. Now it's time for a summary of Alphabet. In analyzing Alphabet, stock ticker symbols GOOG and GOOGL, we learned that the business earns very high average returns on capital of about 21% annually. The company has doubled their revenues, they've almost doubled their net incomes, and they've almost tripled their free cash flows. They've also bought back 6% of their shares. They're sitting on an $84 billion cash cushion and have generated nearly $250 billion in the last 5 years. On both an average and a current basis of their free cash flow to their enterprise value yield, it looked like that was just about in line with the yield of the 10-year treasury, but slightly below that 5% risk premium we'd be seeking. As a note, the company doesn't pay out dividends. When we performed a discounted cash flow analysis of Alphabet, if you've done the work and you believe those historical growth assumptions will be accurate and applicable going forward for the business, it looks like at today's valuations of Alphabet, if you were seeking a 15% rate of return, that a potential fair value for the company is around $80 per share. Again, that's just $3 above the company's 52-week lows. And the last time the business traded at those levels was in October of 2020. So you would just want to be patient here if you believe that. It's worth reiterating that this analysis is not a buy or sell recommendation of any security. It's not financial advice. Before making any investment decision, please consult with the properly licensed and registered legal and financial professionals. With all of the factors of our analysis in mind, it looks like Alphabet is a very strong candidate for further research and that it's an attractive business to dive deeper into. There were a lot of factors about Alphabet to like during our analysis. Alphabet is also a top position held by a number of esteemed value investors, and Li Lu in the fourth quarter of 2022 even added a little bit to his position in Alphabet. That's something I want to keep an eye on as well. I'm happy to make an updated analysis of Alphabet. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Alphabet with me, and have a great day.